Hi, good evening. This is Abhijit Chatterjee and Rohan Singh recording our Charts Are Fun weekly session, the May 31st, Friday. We are recording this in the evening at the market closing. Interesting enough, today's agenda, we will talk, of course, about the usual core ETFs, the Index ETFs, how they performed, then talk about the sector ETFs, how did the sectors perform. And then last week, I did talk about a key barometer that I'm watching, the 10-year yield chart, TNX. Also talk about the Bullish percent index, the breadth of the market, in particular, the Bullish percent index of SPX. And then three key stocks that are in this story. Well, first, we'll talk about NVIDIA. We discussed a potential target of NVIDIA near 1160. We'll see what it did this week. And then three key stocks that were in the news with earnings this week. One was Salesforce, and second was Dell. Both took a hit after earnings. And third stock actually had an outstanding performance, up over 26% today, was Gap, did quite well. So with that, let's just share my screen and start talking about the charts themselves. So let's go to the full screen. So we will mention our blog site. This is something that we publish blogs every day. It's in chartsurfund.substack.com. We encourage you to subscribe to it. You just use your email. It's free, and you'll be notified every day when we post a blog. We usually post a blog only Monday to Friday. And also our YouTube site, Charts Are Fun. That's our channel at Charts Are Fun. We do publish videos every week. I encourage you to check them out and subscribe to the channel. And also, if you do like the videos, we appreciate if you hit the like button so the YouTube algorithms then can share it with a wider audience. So let's go back and take a look at what happened in terms of performance. We lay this out in what's called in stock charts, it's called a candle glance. These are the core ETFs of the various indexes we follow. So the best performer in this list that we follow was the small cap ETF IWM. It was up 1.18%, and the volatility actually was on a climb this week. For the first 3 days, VIX actually closed below the 12 handle, closed closer to 11.9 or so last Friday. This week it had jumped up almost above 14 towards the 15 level, and then today it pulled back down 10%. But overall for the week, VIX was up 1.17. Silver was up about 0.74%. It also had quite a, I would say, big move recently, more towards the first part of May. We can see the very big parabolic move of silver. SLV's ETF, it moved from 24 all the way up to 29.5, pulled back towards the previous week, and then last Friday it had a upswing move again, but then pull back this week, especially the last 3 days of this week. So, and this was a shortened week. We know that the Memorial Weekend holiday was a Monday, so we had 4 trading days this week, and 3 of those 4 trading days silver kind of closed down in red. The Bitcoins, the multiple ETFs, with the core one here is GBTC. It was up 0.64% for the week, and also today, unfortunately, had a down day, down 1.6% almost. Spider ETF, SPY, which is S&P 500, today had a huge reversal. At some point, it was almost near the 518 or so level, and from there it reversed and closed over 527. So that was almost a 9-point move, which translates to in the S&P 500 perspective, almost a 90-point reversal intraday. And in fact, in particular, if you look at the hourly chart, a lot of this buying happened in the last hour, between 2:30 to 4. That's when the smart money moves in, and heavy buying. And this is classic window dressing as well. End of month, kind of smart money moving in, institutional money trying to buy up the market and follow strength. Gold, GLD, had kind of a negative week, down minus 0.2%. Spider was kind of flattish at only up 0.22%. Dollar also had a negative minus 0.28. The NASDAQ actually didn't do so well. The NASDAQ 100 this week, it fell minus 0.47%. And in particular today, there was a very big reversal. It didn't end up closing positive, was negative, but almost at flat, minus only 2 cents for the day. but it had at one point hit closer to 442, reversed higher by 9 points, and closed above 451. TLT down minus 0.64% for the week. Also, earlier part of this week, Tuesday and Wednesday, dropped quite a bit from around the 91 level towards the 88 or so, and then reversed higher the last couple of days, where bond yields kind of came down. So they're inversely correlated. When 10-year yields come down, TLT goes higher, and vice versa. Diamonds today actually had a very, very sharp reversal. Started off at the lows of the day and made almost a 600-point move in the Dow Jones Industrial Index, which is traded in the ETF form by Diamond, DIA. So we can see that it closed almost near the 387, but opened closer to 381. So it's almost a 600-point or 6-point move in the Diamond. The emerging market, the MSCI emerging market ETF, was the worst performer, down 2.62% for the week. And in fact, all 4 days of the week, it closed down. You can see in the red candles for all 4 days. So now from here, moving to the sector ETFs, utilities actually did quite well. They were up 2.7% for the week. In particular, the last 2 days had very strong, nice positive white candles, moving higher, opening at the lows of the day and closing in the highs of the day. So 2 positive, solid white candles in white bullish candles for XLEU. Energy was the next big sector, up 2.15% for the week. The real estate benefits when interest rate your yields come down, and it was up 1.87%. XLC, which is the communication services, is where the internet stocks are, was up 1.67. Discretionary was 1.2. Basic materials was 1.26. Financials were just below 1% at 0.81. Staples at 0.54. And then the 3 industries that were negative for the week was the industrials, minus 0.24%, healthcare at minus 0.85, and the worst performing, which is kind of difficult knowing that this had an amazing move in the month of May, is the technology sector XLK. You can see that at the beginning of May, it was somewhere below the 195 level. And from there, it moved a solid 20 points to 215. In fact, it touched closer towards 218 or so. Since then, this week, in particular, Wednesday and Thursday, from the 217 level or so, that it opened up and closed around Tuesday. Monday was a holiday. It then came down all the way today. In fact, it dipped as low as closer towards the 205, 206 level, reversed higher by the end of the day, and closed it where it opened near the 210 level. So this is actually a bullish looking candle with a long tail at the bottom. So in many ways, you could call it a doji reversal with a kind of a long tail, but opening and closing at the same level towards the highs of the day. So this in near-term momentum would mean that there might be some bullishness next week because of how the reversal happened, reversing quite a bit from the lows of the day and closing towards the highs and the opening levels. So with that, let's talk about the 10-year yield chart, the TNX. This is a barometer of the market, because if 10-year yields keep going higher, and that will happen when market expects the Fed to be hawkish and potentially forget cutting rates, might even raise rates, the yield is going to keep coasting higher. So there is a ascending triangle pattern in this chart that I've talked about before, with the resistance level near 4.35 and the lows in an ascending way going from 38.17, 40.38, 41.83. Those are the ascending lows. So that ascending triangle has the target near 4.92%. It didn't go that high. It touched towards late April 4.73. Since then pulled back to test again key support near 4.3, 43.19 is about 4.32%. Reversed higher, but not till 4.7 yet, somewhere around 4.63, 46.38 is 4.63. But the last couple of days, the 10-year yield has went back again to the 20-week moving average, which is rising. So this is showing a silver cross of the 20 above the 50, both rising. So in some ways, there is a trend for the 10-year yield to go higher. If the 10-year yield does break out from, you could say, some way a cup and handle between 4.3 to 4.63, so that's roughly 30 2 basis points. Add that to 4.63, that's almost 4.95. So that's something to watch. If that does happen, expect a downward momentum in the market. So May, there's the adage of sell in May and go away. We'll have to see if that pans out this year. The recent past, market has maintained momentum from May all the way up to July, and it's usually at the July time when it peaks out. So we'll have to see if we do get momentum into June, into July, and then maybe through the July, August, and September, like last year, we get the pullback. But for the time being, the fact that there is an upward trend on 10-year yield, and if it maintains the 4.35, 4.3 support and keeps rallying higher, it would have a downward kind of momentum on the market. Another thing that I've been watching is the bullish percent. SPX is the percentage of S&P 500 stocks that have bullish looking point and figure charts. That has been printing lower highs. So even though the market climbed higher highs, the S&P climbed all the way from around late October lows, right? It has climbed quite a bit all the way to 5,300 or so. But in particular, as it has done that, so it broke above 4,600, and that measured target of the S&P breaking above 4,600 was actually closer towards near 5,700. It hasn't touched 57 yet, but it came closer to 5,300 plus. And but the bullish percent index has been printing lower highs, and that's a negative divergence. And this week in particular, the bullish percent index fell 9 points, so somewhere from almost near 68 or so came down to, or 66 or so came down to 57. So that was a big drop, and this kind of indicates that fewer and fewer stocks are looking bullish right now. If it goes below 50, that would mean that more than half of the stocks of the S&P 500 are not looking bullish anymore. We know about the word Magnificent Seven. The 7 key stocks, they call it the $1 trillion club, have been holding up the market. In particular, one stock in there is not in the $1 trillion club anymore. That's Tesla, but the others are all strong stocks. And then you have the remaining 493 stocks. And as this bullish percent kind of drops, that would mean that the remaining stocks are not doing so well. In particular, this week, we've known that NVIDIA did take a pullback. So with that, let's look at NVIDIA. We had talked about a cup and handle here between somewhere around the 967 to 756 and coming back to the 958 level, and then forming a kind of a flattish handle here. So a 756 to a 958 is 102 points. Add that, 202 points. Add 202 points to 958. That measures to 1160. We came very close to 1160. We hit 1158 this week, and in particular yesterday is when it hit 1158. And today it pulled back as low as 1070, recovered some of that loss, and closed closer towards 1095, closer towards 1100. Yes, there's a stock split coming in NVIDIA by sometime next week, and we do have to watch. It'll then become $100 or $110 stock, because it's going to be a 10:1 stock split, and then we'll have to see if it can continue its climb and hit closer towards 130, because there is a target closer towards 1350, 1400. If you take kind of a bullish flag pattern. So the flagpole here is from almost at say 473 to 974. That's closer to 500 points. Add that 500 points to the breakout near 950. That's close to 1450. So 1450 is in a split adjusted 145. So this got to be seen if NVIDIA continues momentum next couple of months and moves towards that direction. That said, this week there was software stocks, in particular Salesforce, big time in the news, and the core key ETF for the software stocks is something called IGV. This is the iShares Expanded Tech-Software sector. So all the core like software stocks are in this ETF, and Salesforce, which is one of the big behemoths in here in the cloud SaaS-based software space. In particular, they have grown through acquisitions. They have MuleSoft, they have Tableau, they have their core Slack are all software companies beyond just their core CRM CRM software, or Salesforce, which some of them are part of the data cloud. They took, the earnings was not so bad, but it's just that the forward guidance for the first time in a long time is only a single digit. They've been growing double digit, but turns out for the next quarter, the earnings, they're not going to be growing high single digits, but not growing double digits anymore. And their founder and CEO, Mark Benioff, did talk about the slowing business environment, not being very cautious in signing in larger deals. And people are blaming this more on the AI spending. A significant part of the budget is going on infrastructure build out in the cloud or in their on-premise kind of servers being bought. And that in some ways is impacting the amount of budget spent on software. So that's been kind of the trend. So the IGV, which is this ETF for software, is got an ominous looking head and shoulder pattern. We can see that the neckline here around 77 is kind of support. So it did have a gap from November last year near 76.71, which it did close today because the low was 76.10. It closed the gap. However, there's a left shoulder here from 77 to 82. Back to 77. The head is near 88.8, back to 78.23. From there, the right shoulder got formed at 85. Now this break, it today tried to break, but then reversed higher. But at the end of the day, and closed positive 65 cents. But if the eventual break of this 76 level happens, that measured target is closer towards 66, 67. So that's something to watch. Now, if you look at the core stock of this ETF, Salesforce classically had a descending triangle pattern. We can see this level near 268, 270, having tested multiple times. And as it was testing and climbing, it was getting lower highs, 318, 311, 290. And with these lower highs, that's a descending triangle where the highs are descending and the base at the support level is at 268. That measured target was 214.8. It did meet it. Yesterday it touched 212. And if you look at a longer term chart of Salesforce, 212 becomes a key support. Now, why is it? Because you can see that from 284 back in late 2020, that was high. It pulled back to 212. The 212 happened around January of 2021. Went up then to the highs of 2021 near 311. Pulled back deeper towards the 126, came back and exceeded 311 slightly to 318. So that's in some ways a cup being formed between 126 and 318, and then a handle pullback. In this case, the handle pullback symmetrically matches the pullback we had seen in 2021 January around 212. So it exactly met 212. And now if the possibilities, if we do kind of break out higher above 318, that measured target is 510. So something to look at if the software spending, and there's a lot of AI, Einstein, a lot of AI being infused into Salesforce's products and technology. Tableau is going to have AI-driven dashboarding and visualization, and just the overall productivity of folks using Salesforce platform from an end-to-end product stack will see beneficiaries of AI. And if that happens and the momentum continues and they can turn around in the next quarter again, then perhaps there's a possibility this could be headed past the 318 towards the 510 level. Something to be watched. If that happens, of course, and the chances of IGV having a head and shoulder breakdown gets negated, but it's still a bit too early. Today, in this week, for example, it was not just Salesforce. We've had companies like, it's very big in the robotic process automation software. They took a very bad hit as well, missed earnings numbers, and it's something that UiPath is in the company. And then also ServiceNow had a kind of a setback, and we also know that a key stock that Palo Alto Networks has also been hit in the recent past. So it's across the board in many SaaS software vendors, and we realize that they are interest rate sensitive. Many of these, of course, Salesforce is hugely profitable, but some of them are not, and they have huge marketing expenses. They do still have losses, and they need to raise capital as a result to grow. And if the cost of capital keeps increasing with higher interest rates, the higher for longer thing, then that's not good for software stocks. So that's something something that does have a negative impact. So if this head and shoulder breakdown does happen below 76 towards the 67, the likelihood is that that would be followed by the 10-year yield breaking back above 4.65 towards the 4.9, 4.95 level. That could cause this head and shoulder breakdown, something to watch over the next few months. With that, I do want to talk about Dell, a story stock. It's been doing extremely well. The layout of AI server spending, whether it's the hyperscalers buying Dell servers to add GPUs into their environment, or large companies adding the Dell servers into the data centers. Dell kind of had margin issues. So they did announce margin concerns, saying that they've had bigger deals with the hyperscalers, which negotiate better deals, and hence the profit margins are lower, versus for the same amount of sales, for the worth of the dollar, if they were selling to smaller customers, that would have given them higher margin. But the trend so far has been that the big hyperscalers, whether it's Tesla, or it's folks such as Google, Microsoft, and Amazon, have been buying at much tighter margin, and that's hit their margin. And stock did take a big dip. It had gone absolutely parabolic. If you look at Dell stock here, it is a bit of an ascending triangle from 130 to 135 to 104. So that's about a 31 point to 135. That's like 166. It did exceed 166 and touched 179 this week. On Wednesday, it did that. Yesterday, it pulled back in anticipation of perhaps some weak earnings, and took it to date gap down big time, closed almost 18% lower, down $30 in towards the 140, below the 140 level. So that's something, and it did nicely test the 50-day moving average. That's somewhere around 130, and it tested 131 and rebounded from it. So that's temporarily bullish, that it did hold the 130 kind of in the 50-day moving average support. So maybe it might try to go close up the gap towards the 160, but we have to now watch if it does hold that to reclaim the 179 and do higher high, or kind of stays range bound now between 130 and 180 for the next several months. With that, another story stock, but done the opposite of what Salesforce and Dell stock did. Dell was a hardware play, Salesforce was a software play, was a retailer. This is a casual retailer, Gap. They've had outstanding earnings. They brought on the Mattel's chief operating officer as the CEO last year. He's gone around, traveled across their stores. They have 4 key brands. Athleta is one of them. Athleta did quite well in terms of revenue growth. This is athletic sportswear. They have Simone Biles with the Olympics coming up in Paris as their brand ambassador. She does outstanding in gymnastics, so that's got some momentum for them this summer. Their brands, Banana Republic, they have their Gap brand. They have a couple of other brands. Athleta is one of their brands as well, are all doing quite really well, and it's to be seen how well the momentum continues. But this long-term chart on this is very interesting, that we see a double bottom near 7. So 2022 was the bottom at 7, went up to 14, came back towards 7 again in 23. So that's a double bottom, a nice beautiful double bottom with a positive divergence, because RSI was at a higher low when that double bottom formed, breaking above 14 towards 21. So 7 to 14 is 7 point at 7 to 14, 21. So that's the cup with a W-shaped cup, and then a handle from 21 to 19. That cup and handle from 7 to 21 is 14 points. Add that to 21, that's 35.78, plus adding the difference from 6.91 to 21.78, it gets closer to 36.65. So that is above the previous highs at 21 here, 32.9. We can see 32 was being a key level in the past as resistance. So 32 to 33 will be resistance. But if this cup and handle between 7 to 21.78 pans out, there's a good chance it's headed towards 36. That's where Gap could be headed. So it already closed up 41% for the month. So this is the monthly chart. Each candle is a month. So it had a pretty outstanding move, but in particular, 6 of these point moves happened just today. So had a very, very solid move, Gap after earnings. And with that, I think let's just wrap up, discuss what all happened this week. Key is, yes, we forgot to mention that we did have the core expectation of inflation that the Fed watches, called the PCE. The PCE came out tame this week. It actually came out today. Expected the core PCE came in, and this is taking food and energy out, came in at 0.3 month over month, and the actual the headline PCE was up 0.2. So that was tamer. Both came in as expected, and market liked it. So the market thinks that perhaps inflation there was hot inflation in the first few months. A lot of that was owner's equivalent rent, housing costs, and so on. But and also services costs. A lot of the auto insurance costs have been shooting up. But the market is expecting that perhaps if inflation shows a couple of months of slowing down, there's already a fear of unemployment hitting 3.9%. So market will be watching next Friday's jobs number. That's going to be the May jobs number coming out on the first Friday of June, which is the 7th of June, next Friday. If the unemployment there crosses 4 handle, so it was at 3.9 the previous month, that would perhaps shake up the Fed a bit to consider being dovish, and maybe even there are some folks who, like I heard the chief economist of Moody Analytics this afternoon at CNBC say that he's expecting a cut even as early as July. Many don't think it'll be a July. They think at the best market may get 2 cuts, perhaps even 1 cut. But with an election year, with unemployment creeping higher, if inflation shows any further signs of slowing down, there is a chance that they may even start cutting in July. But they are being very cautious. Anil Kashkari in particular is one of the Fed governors who's been extremely cautious. He's out of the Minneapolis sector, thinking that the market does need to demonstrate that there is real, a real direction or a real trend in inflation coming down and not a transitory thing, and the fear that higher for longer stance might be needed really to curb down the inflation. So with that, happy trading next week, and good luck with your investments.